are just in time for your most comprehensive weekly look at the world of business and economics. Welcome, I am Julian Samboko and this is Business Redefined. It is the budget season, and unlike the past where the finance bill has been tabled after the presentation of the national budget before the National Assembly, this year the finance bill has preceded the budget. The finance bill, which is when passed by National Assembly becomes the Finance Act, is proposed legislation which spells out the measures which will be adopted by the government in its revenue-raising efforts for the next financial year. Now, Section 12D of the Finance Bill of 2020 provides for the adoption of a minimum tax at 1% of turnover. This is intended for taxpayers who are carrying out businesses and their tax payable is lower than 1% of their turnover. Effectively, this would go as far as roping loss-making businesses into the tax net, a proposal which has sparked heated debate among Kenyans. If passed by Parliament, what would this legislation mean for the business environment? Why is the government pursuing such an option? And why at this time when many businesses are struggling simply to stay afloat? Our starting point this week is a report by Victor Kiprop on the proposed minimum tax.
Revelations by a 2019 report by the Kenya Revenue Authority that more than 90% of registered companies in Kenya do not pay corporate tax may be behind the National Treasury's push for the proposed minimum tax. If approved by Parliament, the tax will see all persons whose income have not been taxed elsewhere pay a tax rate of 1% of their gross turnover.
The implication of this is that many businesses which are loss-making will now be making taxes or paying taxes on annual basis. So the problem we see here is that how can you be paying tax and you're making losses? In
Kenya, registered companies pay a 25% corporation tax on their annual gross earnings, meaning businesses that have recorded losses are exempt. According to data tabled before Parliament by KRA in September 2019, of the more than 400,000 companies registered for corporate tax in Kenya, about 168,000 filed their tax returns, but only about 33,000 paid taxes, translating to a compliance rate of about 8% and pointing to possible tax evasion by companies. The tax exempts income from employment, residential rent, capital gains, or if the income is subject to turnover tax or the minimum tax payable by the company is lower than the installment tax payable. The tax borrows from provisions in other countries where businesses that make losses are subject to a minimum tax.
It's something which has been adopted from various African governments, and closer home is Tanzania, which is doing that. We don't think it's fair in instances whereby somebody is telling you to pay tax when actually you're not making any money in terms of profits.
The push to tax even loss-making companies reflects the government's desperate attempts to unlock more revenue streams in an economy that has already taken a beating from the coronavirus pandemic. The economic stimulus package announced in March has already left a 172 billion shillings hole in the national budget. The International Monetary Fund (IMF) has since downgraded the country's risk of debt distress to high from moderate, and with loan redemptions and interest payments expected to eat up to 904 billion shillings in the next financial year, one could say that the country's Finance Minister Ukur Yatani is walking a tightrope. Victor Kiprop, NTV.
Now, how to widen the tax base and meet Kenya's ambitious revenue targets is the perennial headache that the Kenya Revenue Authority has to grapple with. Despite the introduction of measures such as presumptive tax in the financial year 2017-2018 and turnover tax in the financial year 2018-2019, revenue targets remain largely elusive, with KRA decrying a large informal segment of the economy. The current situation has been made even challenging with the raft of tax cuts and increase in cash transfers extended by the government in light of the COVID-19 shock. Now, let's take a look at the evolution of revenue mobilization in Kenya with a look at key numbers. If you look at this graphic here, starting 2014-15 to the year 2018-19, Kenya has mobilized from just about 1 trillion shillings to 1.62 trillion shillings in terms of tax revenue. And the key challenge here, you'll note that is always being pointed out, is that the tax revenue is not growing as fast as the economy is growing. And that has led to the discussion around tax buoyancy and the challenges that Kenya is facing. But away from this, let's dig deeper into the issue of the taxation of businesses and how those numbers look. If you look look at this data from the Kenya National Bureau of Statistics, in terms of tax revenue from businesses, which is largely corporation tax, we have moved from just 229 billion shillings to 363.7 billion shillings in the last financial year. And of course, here the discussion is we have an extremely large informal segment of the economy, and therefore majority of them are not in the tax net. And this is part of the headache that KRA has to grapple with every year when it's looking at its targets. But away from this now, let's look at the dichotomy of all these numbers. And I should point out that these numbers are actually in percentages. If you look at this pie chart, it is indicating in terms of tax revenue for the country as a whole, the largest contributor is value-added tax, which comes at 26.9%. And this is part of the challenge the government is having right now because it scaled down VAT from 16 to 14%, if you recall. And next, we have the pay-as-you-earn, which comes at 25.5%, building further to the challenges being faced by the government because, of course, any person earning 24,000 shillings and below has now been given 100% tax relief, which means they are not paying any tax. And after that, then we have tax from businesses, which is at 22.4%, another pressure point because you'll remember that corporate tax has been scaled down from 30% to just 25%. And finally, we have tax from international trade as well as other segments. Now, this ushers us into our discussion. And after the break, I'll be joined by Edna Gitachi from PwC, who will be helping us make sense of the issues around the minimum tax debate. That's right after the break.
When you sit with a plate of food today, pledge to stand for someone who has put food before you. Dial *126# to transfer your bonga points now so they can buy food and necessities at any outlet with a Lipa na M-Pesa till.
Safaricom is for you.
Basic protective measures as guided by the World Health Organization. Clean hands frequently with soap and clean water. Cover nose and mouth when coughing and sneezing with a tissue or flexed elbow. Avoid close contact 1 meter or 3 feet with anyone with cold or flu-like symptoms. If you have fever, cough and difficulty breathing, seek medical care early. Avoid raw or uncooked animal products. Help the world put an end to the spread of respiratory diseases by sharing this message with a friend. Message brought to you by Sour Herbal Family Bath Soap. There's no debate. Home is best. If you must pay for deliveries, use your NCBA debit card. Stay home. Stay safe.
For a better tomorrow, don't forget to do the 1, 2, 3 with Colgate every night.
Right, welcome back to Business Redefined. Tonight we are focusing on the subject of the minimum tax debate as proposed by the Finance Bill of 2020. In case you're looking out for it, it is in Section 12D. And of course, the proposal is that businesses should be paying 1% of their turnover as minimum tax, something which has sparked a lot of debate in the public domain. And of course, as I mentioned before the break, I'm joined by Edna Gitachi from PwC, where she's the tax policy lead, focusing on that subject. And Edna, my first question is, I'm still trying to make sense of this whole discussion around minimum tax because it is, if you read the finance bill, it is under income tax. But the way we define income is revenue minus your expenses. So in the event that I'm in losses, definitely I'm not in the income bracket, but still I would be subject to this tax. Where exactly does it fall? Is it an income tax? Is it a sales tax?
Thank you. Amboko, first and foremost, thank you very much for having me on this show. And to all our viewers, a very good evening. So Amboko, to your question, this is actually an income tax proposal. So what is going to happen, as you rightfully noted, is that businesses who are currently paying tax that is less than 1% of their gross turnover will be required to pay tax that is equal to 1% of their gross turnover. So what does this mean? It means that if you're already paying taxes in excess of 1% of your gross turnover, then you are not under the ambit of minimum tax. And it's a very innovative way of the government trying to bring in many people to contribute to the exchequer through taxes.
But Edna, in the event that I'm in the loss territory, that's where the biggest concern is, will I still be subject to this?
Yeah, Amboko, so the unfortunate thing is that if you're making losses, then you'll be subject definitely to the minimum tax. And there are quite a number of questions that arise. There could be many reasons why companies are in losses. Like, for instance, during this period of the COVID-19 pandemic, would be expecting that very many businesses will end up in losses. So now adding this extra burden of minimum tax is very punitive, especially during this time, which also takes me to the question of, is the timing of this minimum tax right?
Brilliant point you raised there. And my question next is that it reads to me like it's a very clever, or should I say witty way of the government of taking VAT back to 15%. You remember they reduced it from 16 to 14%. But the moment you slap me with 1% of gross turnover tax, then definitely you are finding an intelligent way of bringing it back. Don't you think so?
Well, Amboko, I think these two are very separate legislations. So VAT is anchored in the Value Added Tax Act, whereas Minimum Tax Act, tax will be anchored in the Income Tax Act. It is possible for you to have minimum tax and at the same time value-added tax. So how it works out is, so long as you have hit the threshold of VAT registration, which is currently at 5 million Kenya shillings, then you'll be required to register and account for VAT. So it is possible to have both minimum tax and VAT, but there'll also be instances where there'll be taxpayers will only be subject to minimum tax and no VAT, where their threshold for VAT is below the 5 million.
And Edna, I'm still trying to think around this, because if I read the bill, it indicates that this, the minimum tax, should it be passed, will be paid on a quarterly basis. Now, typically, I have always known that income tax is looked at from an annual basis. So the scenario here is that, for example, I have a very good Q1, but my next 2 quarters are terrible. Where will this leave me in terms of how I account for this minimum tax?
Yeah, Amboko, there's actually a challenge right there when it comes to the way the proposal is drafted, because we should be expecting to be paying minimum tax at the end of the year once you have your full year financial results. As you have rightfully mentioned, there could be a situation where in one quarter you're doing very well and you're therefore not under the regime of minimum tax, and in another quarter business is not doing as well, like during this period of the COVID-19 pandemic. So there will be an issue of, do you then move to the minimum tax regime or not? So in terms of best practice, it probably would be best for this to be accounted for at the end of the year, where you'll actually be able to assess, did you meet the threshold of at least 1% of your gross turnover or not?
Clearly, there are some kinks there which need to be fine-tuned. And speaking about best practice, clearly this is something which is borrowed from other jurisdictions. Of course, Tanzania does have this kind of legislation in place. What would you recommend as the best practice? Because there's a lot of debate out here, and perhaps the discussion, in my view, should not be whether we should have minimum tax or not, but the rate which is now being proposed. Should it be, let's say, 0.5% or 0.3%?
Amboko, there are quite a number of issues with the way the current proposal is drafted. So you have rightfully talked about the rate. So the rate, if you're to benchmark with other countries within this region, that's Tanzania, and Uganda and Nigeria, the rate is 0.5%. So the 1% is on the higher side. And besides the rate, there are also other issues. For instance, if I have just started a business this year, I may not necessarily end up in profits. So it will be very punitive to then be subjected to minimum tax, because effectively I'll get a tax on my capital. From best practice, what happens is that there's a grace period that is given to new businesses or businesses that are in a loss position, a grace period of about 3 to 5 years. So this is something that possibly should be considered.
Edna, I'm a little worried about Kenya's tax policy framework, because as a business, typically what you would want is predictable tax policy. Now, every year we seem to be tweaking this depending on where we think money can be drawn from. So in the 2 financial years ago, we were talking about presumptive tax, which didn't work too well. Then we went back to turnover tax. Now we have minimum tax we're adding on top of this. Do you share this concern?
Well, I do. And I think what National Treasury is really grappling with is how to expand the tax base. Now that you have talked about turnover tax and presumptive tax, the target was the informal sector. But when we are looking at minimum tax, the target is no longer the informal sector, but it's actually looking at the taxpayers that are already in the tax net and trying to see how can we ensure that all these taxpayers pay at least 1% of their gross turnover as tax, corporate income tax contribution. So, but in terms of the policy, it would be good and would encourage the national government to make available the tax policy that they have for the sake of businesses, because this then is going to create some level of certainty.
Edna, to play the devil's advocate here, the government, in light of COVID-19, gave us a raft of relief measures. Tax cuts came thick and fast. Then, of course, we had the cash transfers being enhanced. Surely Kenyans should have seen this coming, because where else will KRA be drawing money from in terms of financing government expenditure? Just to be fair, where do you think this leaves the government? Because the National Treasury tells us, in light of all the tax cuts, it will be foregoing about 180 billion shillings worth of tax revenue.
Well, Amboko, I think we can still be able to collect, but definitely not the same amounts of tax that we have collected in a normal year. So I see KRA actually being more aggressive in terms of audits that they'll be carrying out. And these audits, which we know are risk-based, so most likely the large taxpayers will be subject to a lot of audits. We also think that KRA is going to leverage on their iTax platform to carry out these audits. And as a result of the audits, we are also expecting a number of tax disputes. So to unlock revenue, all eyes will be on the Tax Appeals Tribunal and the alternative dispute resolution within KRA to be able to see how much revenue can be unlocked for the country. But having said that, we also need to look at the budget holistically. We are looking at the revenue, but we also need to focus on the expenditure and see where can we have significant tax cuts.
And Edna, when you look at the implementation of this minimum tax, should it be passed by the National Assembly, how do you see that unfolding? Because we have had a precedent where presumptive tax is passed, but then the implementation, for the lack of a better word, just turns out shambolic, and of course we don't hit our targets.
So I think, Amboko, first of all, my prayer would be that this is deferred and National Assembly considers this proposal so they do not pass it during this period of the pandemic. If we look at the current wording, it is not very well written, and it would be important to have a policy around minimum tax, and again to benchmark further with other countries that have implemented this for a longer period and see what we can be able to borrow from them.
And getting to the tail end of our conversation, finally, when all is said and done, we all know that there are ambitious revenue targets being set for KRA. How do you see 2020, 2021? Because we still have a number of obligations. If you look at our consolidated fund, for example, we still have to meet some debt obligations. Never mind, we had some reprieve there, as well as pension.
I think this is a really tough task for government at this point in time, because as a result of this COVID-19 pandemic, you can imagine that businesses are struggling to keep afloat. So we expect quite a number of them to be registering losses during this period. So 2020 is definitely going to be a tough year from a revenue collection perspective. So the only efforts that I see the KRA trying to employ is what I had alluded to earlier, trying to see whether there are any tax leakages, either from an evasion perspective or just a normal tax audit perspective, and to try and mobilize these funds. I think the other thing from a government perspective is to continue embracing public-private partnership programs so that we can continue with some of the infrastructure development.
And my final question, Edna, because I'm told we're running out of time. You have talked about best practice. If there's one country you would recommend that we try and emulate as far as implementation of minimum tax is concerned, which one would this be?
I think I would pick Nigeria. Nigeria has had minimum tax for a longer period, and they have quite a number of issues that we've discussed in this show that have been implemented. So it would be good for the government to benchmark with Nigeria.
Many thanks, Edna Gitachu. We truly appreciate your time and your insights regarding this subject. That has been Edna Gitachu, the tax policy lead at PricewaterhouseCoopers in Kenya. She's been shedding insight on some of the challenges that we are likely to face in terms of implementation of the minimum tax as proposed by the finance bill. But please remember, this still has to go to the National Assembly. Her proposal is that it should be deferred. To be honest, I don't see that happening, because if you read the IMF report, it is already concerned about fiscal consolidation and the kind of muscle we will be losing through the raft of tax cuts that we have extended. Up next is a markets review. sorry, just to mention that again, the NSE 20 share index closed at 2,007.49 points, and that on a change in terms of year to date is down 24.37%. Of course, investors are taking a beating there, but on a day-on-day change, rather, it has gained by 0.7%, which is quite some welcome news for investors looking there. But moving on to the forex market, if you look at the Kenya shilling, it is gaining against major currencies, closing to the US dollar at 106.69. That is up 0.3%. That is, I should say, appreciation. In terms of the sterling pound at 129.97, up by again 0.3%. And against the euro at 115.62 units. That's just up by a marginal 0.03%. So definitely the shilling there remaining quite a bit resilient against major currencies. And that now takes us to the close of business as far as Business Redefined is concerned. Definitely tonight we have been focusing on the subject of the minimum tax, something which has sparked a lot of discussion online as well as on the streets. Remember, you can still be part of this conversation on Twitter at NTV Kenya, at AmbokoJH. The hashtag is Business Redefined. We continue to highlight issues of public interest, and let's do this again on Tuesday next week, same place, same time.